Welcome to the deep dive. Today we've got quite a stack of material here. We're looking into Fischer Medical Ventures Limited, or
Oh.
FMVL. They're a big player in medtech.
That's right. And we're digging into their recent performance, so specifically the unaudited financials for Q2 and the first half of FY26. But it's not just numbers.
No, definitely not. We've also got major strategic announcements, global expansion news.
Exactly. So the goal here is to really connect the dots for you. How does this, well, frankly, explosive financial growth link up with their strategy on the ground?
Yeah, because the headline number is what? 123% jump in total income year over year for the quarter? Almost 89 crore? That's big.
It is big, but honestly, the profitability figures, they're even more dramatic,
Yeah.
almost unbelievable at first
So
glance.
let's maybe start there. Let's unpack the raw figures, the consolidated ones first. Okay, so focusing just on Q2 this year versus Q2 last year, total income, as we set up, 122.64%. From about 40 crore to nearly 89 crore.
Solid top line growth, definitely. But, medtech can often be about volume, sometimes with tight margins. So the efficiency question is key.
Right. How much did it actually cost them to make that extra revenue?
And this is where it gets, well, kind of wild. Look at EBITDA earnings before interest, taxes, depreciation, amortization. It didn't just double with revenue.
Right.
It surged by over 2,500%, 2,511.72% to be exact.
Wow. Okay, what were the actual numbers there?
It went from a really tiny euro 0.72 crore in Q2 last year, basically break even,
Yeah.
to 18.74 crore this quarter, nearly 19 crore.
That's a massive shift. That suggests something fundamental changed in how they operate, right?
Absolutely. It points to incredible operating leverage kicking in, and you see it starkly in the EBITDA margin.
Let me guess, it jumped significantly.
It leaped from just 1.80%, barely profitable on an operating level, to 21.0%.
21% in 1 year.
Yep. That's a 1,930 basis point improvement, almost 20 percentage points added to their operating margin.
Okay, that's the real story underneath the revenue number, isn't it?
Yeah.
That kind of margin expansion is, well, it's huge.
It implies they're not just selling more, they're selling it much more profitably. Either costs plummeted or the value of what they're selling shot up or, likely a mix of both.
So how did that translate down to the bottom line, net profit?
Predictably spectacular. Given the EBITDA jump, net profit surged. Get this, 4,659.63%.
4,600%.
From just 180.29 crore, less than 30 lakhs, to almost 14 crore, 13.96 crore, technically.
Okay, and the net profit margin?
Followed suit. Rose from a tiny 0.74% to 15.72%. Again, a nearly 15 percentage point improvement.
15% net margin in this sector.
That's strong.
Very strong. And just briefly, the half-year numbers, H1 FY26 versus H1 FY25, showed a similar, actually even more extreme trend. Net profit there was up over 10,000%. Okay, I have to ask the skeptical question. Numbers like that, 4,000%, 10,000% growth.
Yeah.
It screams one-off event. Like, did they sell a building? Was there a massive tax credit? Or is this actually sustainable operational improvement?
It's a fair question, but according to the company's management, specifically the chairman, Mr. Ravindran Govindan, they're attributing it primarily to operational factors.
Such as?
He mentioned three things: the scalability of their business model, achieving, and this is their term, better product realization, and growing acceptance both in India and, importantly, overseas.
Okay, better product realization. Let's unpack that a bit. Does that mean they're getting higher prices for their equipment? Or finding ways to make it much cheaper? Or maybe shifting the mix towards higher-end stuff?
It likely means a combination of those things, but I think the context suggests it's heavily weighted towards efficiency and moving up the value chain. Product realization is really about the net value you capture from selling something. So given their big push on indigenous manufacturing, which we'll get to, it probably means, one, they're controlling costs much better by making things locally, that's the scalability, and two, they're successfully selling more complex, higher margin systems.
Okay, so making it cheaper and selling pricier things. That combination could definitely explain that 21% operating margin, if it holds.
Exactly, and that's the crucial link to their strategy, which brings us neatly to the strategic side. Because that margin story doesn't happen in a vacuum. FMVL seems very deliberately aligned with some big trends in Indian healthcare right now.
Like the government's push for local manufacturing.
Make in India.
Presley. Also, the increasing focus on preventive healthcare and, maybe most cutting edge, the drive towards AI-driven diagnostics and solutions. FMVL is positioning itself right in the middle of that supportive environment.
Okay, let's look at the local manufacturing piece.
Yeah.
The sources say their subsidiary is the first Indian company recognized by the CDSCO, the main medical device regulator for making MRI systems domestically. Why is being first such a big deal? Well, it creates a pretty significant advantage, or moat, as they say in business. Being the first recognized local manufacturer likely puts them at the front of the line for government contracts and tenders.
Ah, okay. Procurement preference.
Yeah, and potentially benefits like lower import duties on components. Plus, it builds huge credibility. We're talking complex machines here. Their range includes 0.35 Tesla and 1.5 Tesla MRI systems. This isn't simple stuff.
So it potentially locks in a solid domestic revenue stream for high-value equipment.
That seems to be the strategy. And we're seeing deployments already. They launched a high-resolution open MRI at a place called Sunray Scans in Chennai.
Okay, major city diagnostic center.
Right. But they also installed a PI-CA, a 0.35T open MRI at ST&M Hospital way up in Sikkim.
Sikkim. Okay, so that's interesting. Hitting both the big metros and more remote, maybe underserved region.
Exactly. That diverse footprint looks quite deliberate, quite strategic, spreading the technology.
Got it. Now, what about the AI pillar you mentioned?
Right. This is fascinating. Their joint venture partner is a company called NYB.ai, and they just won first prize at something called the Super AI Genesis Global Competition.
Okay, sounds impressive. What did they win for?
For an AI platform focused on drug discovery. It's called DTIGN. Now, winning an award is nice validation, but...
Who else was involved?
Exactly. Look at the partners mentioned alongside this competition. NVIDIA.
Okay, the AI chip giant.
Johnson & Johnson Innovation.
Big pharma R&D focus.
And Hewlett-Packard Enterprise, HPE.
Major tech infrastructure player.
Right. When those kinds of names are associated with the ecosystem NYBAI is playing in, it tells you this isn't just some small regional award. It signals that FMVL, through its JV, has genuinely world-class AI capabilities.
And capabilities that go beyond just making images clear, moving into drug discovery. That's a whole other level.
It really is. It suggests serious ambition and potential access to completely different, very high-growth markets down the line.
Okay, so we've got strong financials, a domestic strategy based on local manufacturing and AI. But that chairman's quote also mentioned growing acceptance overseas. The source suggests this isn't just gradual growth, though. It looks more like a very targeted push into Southeast Asia.
Yeah, aggressive land grab might not be too strong a term based on these moves. They seem to be setting up a significant presence, quite strategically.
How so? What are the key moves?
Okay, two big ones highlighted. First, Malaysia. They've actually acquired a landmark mixed-use property.
Not just rented an office, then. Bought property.
Correct. And the stated goal is explicit. Develop an integrated regional healthcare hub. This sounds like it's intended as the command center for their entire Southeast Asian operation, logistics, strategy, distribution, everything.
Okay, so Malaysia is the regional HQ base. What's the second big move?
That's in Indonesia. And it's quite different. It's a public-private partnership, a PPP, with the city of Jember.
Interesting. What's the project?
They're deploying AI-powered portable X-ray systems, and it's tied directly into a major public health campaign supporting Indonesia's national goals for TB elimination. Specifically, the local target of TB-free Jember by 2026 and the national goal for 2030.
Wow. So using their tech for a massive public health screening program.
Seems like it. And the sources mention this project value is around USD 10 million. It positions FMVL not just as selling equipment, but as a partner in achieving national health outcomes. That's smart positioning in markets with large government health programs.
Especially with portable AI-enabled tech that can reach areas traditional equipment might not.
Yeah.
Accessibility and affordability, right?
Exactly. And critically, the sources also note they've secured full licensing in Indonesia.
Which means?
Which makes them eligible to bid on the upcoming NTB handheld X-ray government tender. That initial Jember project could just be the foot in the door for something much larger, potentially nationwide.
So MRI machines, AI platforms, portable X-rays. But there's another piece in their portfolio, right? Through their nanometric unit, SpinCare.
Yes, SpinCare. This is different again. It's described as using advanced diagnostics, more in the realm of advanced wound care or maybe tissue regeneration. The sources link it to nanomedicine.
Okay, another high-tech area. What's the key news here? Sounds like it's about regulatory progress.
It is. For high-tech medical devices like this, navigating the regulatory maze is everything. That's what unlocks commercial potential.
So where are they with SpinCare?
They've completed phase 1 of the MDR-MDD audit. That's the stringent European medical device regulation process. Phase 2 is apparently due in October 2025, so quite soon.
Okay, Europe is one major market. What about the U.S., the FDA?
They're actively preparing the FDA filing for SpinCare now. The sources say they expect an outcome on that in Q4 of FY26.
So within the next fiscal year or so, getting clearance in both the EU and U.S. would be huge, right?
Absolutely. Those are the two biggest, most influential medical device markets globally. If SpinCare is a high-margin product, getting those approvals could be really important for sustaining the kind of profitability we saw in Q2.
And is there clinical data to back it up, beyond just the regulatory filings?
Yes, and this seems crucial. The sources mention two specific points. SpinCare has been proven safe and effective in treating pediatric burns.
Children's burns. That's a very sensitive application. Success there speaks volumes about safety.
It really does. And separately, a trial conducted at Stanford University apparently showed strong tolerability with no adverse events reported.
Stanford validation. Pediatric safety data. That's the kind of evidence clinicians look for. It makes the product feel much more real and impactful.
Exactly. It moves it from just a potential technology to something with proven real-world application and safety, which is key for market adoption once the regulatory hurdles are cleared. Now, when a company is growing this fast, expanding globally, making big bets on tech, you also need the right governance structure. The board needs to keep pace.
Makes sense. You need the expertise to oversee all this complexity.
Right. And interestingly, the board met on October 28, 2025, and approved or recommended two near independent directors. And their backgrounds seem, well, very specifically chosen for this global push.
Okay, who are they? Let's start with the first one, Mr. Chan Seng-en. He was appointed effective that date.
Mr. Chan. His profile reads like a playbook for Southeast Asian investment and operations. 3 decades of experience across SEA in Australia,
Spelling in.
private equity, corporate finance, but also things like operational turnarounds, reverse takeovers, and pre-IPO consulting. He's currently principal and director at Soft Capital in Singapore.
Okay, so deep financial and operational expertise, particularly in complex situations like turnarounds or getting companies ready for public markets.
Yeah.
How does that fit FMVL right now?
Well, think about it. A company whose profits just jumped 4,600%, expanding rapidly across borders, potentially integrating acquisitions for that Malaysian hub. You need someone who understands high-level corporate structuring, financial discipline across different countries, managing rapid scaling efficiently. He sounds like the nuts and bolts financial scaling expert.
Got it. The operational heavyweight for the expansion. Who's the second new director? Recommended, not yet formally appointed, perhaps?
Yes, recommended for appointment. Tan Tridata's Dr. Syed Jalaluddin. His profile is quite different.
How so?
He's described as a distinguished academician, a visionary leader. He's 81 years old, with over 50 years contributing to Malaysia's higher education and corporate sectors. Former Vice-Chancellor of University Putra Malaysia, UPM.
Okay, so deep roots in Malaysian academia and leadership. What about corporate experience?
Significant. He served as chairman or independent director for major Malaysian corporations. Petron Berhad, Bank Rakyat are mentioned. High-level governance experience.
And the sources also highlight his role in the global halal industry, chairman of the Halal Industry Development Corporation. Why is that relevant for FMVL?
That could be absolutely critical for their Southeast Asia strategy, particularly in Malaysia and Indonesia, which have large Muslim populations. Halal certification and compliance isn't just for food. It can be crucial for medical consumables, pharmaceuticals, even how services are delivered.
Right, so having someone with deep expertise and credibility in the halal ecosystem could smooth their entry and acceptance significantly, especially for government contracts.
Precisely. It shows cultural and regulatory sensitivity at the highest level. Dr. Jalaluddin seems to bring that deep regional network, the high-level governance perspective, and crucial cultural regulatory understanding. He provides legitimacy and alignment.
So it looks like a very deliberate pairing. Mr. Chan brings the hard-nosed financial and operational scaling know-how for ISE.
And Dr. Jalaluddin brings the top-level governance, the deep Malaysian regional network, and the crucial cultural and regulatory navigation skills.
Makes perfect sense for a company aiming to build a major regional hub in Malaysia and win big contracts in Indonesia. #outro.
So if we tie this all back together for you, that incredible financial performance we started with, The huge jump in margins and profit, it doesn't seem like a fluke.
No, it looks like it's really underpinned by this multi-part strategy taking shape.
Exactly. They're driving down costs and securing domestic markets through local manufacturing. They're betting big on future tech with AI, validated by major partners. And they're making very concrete, aggressive moves into Southeast Asia, building infrastructure and winning public health partnerships.
It feels like the numbers are starting to validate the strategy. That 4,600% net profit jump.
Yeah.
You don't get that by accident.
It's
It
great.
suggests their push for accessibility and affordability combined with optimizing that product realization is actually working financially.
Right. So we've seen the strong Q2, we've seen the focus on Malaysia as a hub, Indonesia as a major contract win, and now these board appointments with deep, deep roots in Malaysia specifically. So here's a final thought for you to chew on. Given that dual focus, the Malaysian hub infrastructure and the Indonesian public health contract, what does appointing directors with such profound Malaysian corporate and academic connections signal?
Where might their immediate big push be focused?
Exactly, especially when it comes to deploying their higher margin, indigenously manufactured systems like MRIs or maybe even spin care once approved. Does the Malaysian focus and governance suggest Malaysia might be the primary target market for those high-value systems even before Indonesia scales further? Something to watch.